Chapter 6 covers accounting for merchandising businesses. And if you're in the business of selling goods, then at some time you are the buyer or the purchaser. So I'm going to write that over here, the buyer. And other times you are the seller. Because if you're in the merchandising business, that means you sell stuff. So you've got to buy inventory first before you can sell it. So we're going to look at this problem based on who we are. First, we're going to do the journal entries as if we were the buyer, and then second, we're going to do the journal entries as if we were the seller, because you're looking at it from the flip side, depending on whether you're the buyer or the seller. The buyer entries are fewer, and so because of that, they are easier. So we're going to do that first. In part 1, A company sold $10,000 worth of merchandise to B company. So first of all, the seller is A company and the buyer is B company. It says the credit terms are 3, 15, and 30. That means that you can save 3% if you pay it off within 15 days. And the cost of merchandise that was sold was $6,000, but we won't worry about that until we are doing the entries for the seller. So first of all, B company buys merchandise. So when we purchase merchandise, our debit is to merchandise inventory, and our credit is to accounts payable dash A company, because we owe A company money. And the amount of the purchase is $10,000. Then, in part 2, B company, that's us, the buyer, returned $2,500 worth of merchandise to A company. The cost of the merchandise returned is not our business because we're the buyer. So what we're going to do is the journal entry to record the return. So we'll debit accounts payable, because now we've returned some of this, so we owe them less. So we'll debit that for the amount of the return, $2,500, and we'll credit merchandise inventory because it's no longer in our inventory. We have returned it for $2,500. And then in part 3, B company paid the invoice within 15 days to take advantage of the discount. And so at this point, we've got to figure out, well, how much are we going to write this check for, because we are the buyer. So we owe $10,000 less $2,500. Means that we owe $7,500. But they've offered us a discount of 3%. So we can save 3% if we pay it early. So we're going to figure out 3% of $7,500, which is $225, which means the amount of our check is $7,500 minus $225, which is $7,275. That's the amount of our check. As the buyer, we'll debit accounts payable A company for the full amount we owe them, which is $7,500. We'll credit cash for the amount of our check, $7,275, and we'll also credit merchandise inventory because the taking advantage of the discount actually reduces the amount we paid for the inventory, and so we're going to reduce our inventory account. These are the 3 transactions for the buyer. Now we're going to look at the transactions for the seller. Here it says A company sold $10,000 worth of merchandise. So we're going to debit accounts receivable B company and credit sales for the full sales amount, $10,000. As the seller, whenever you have a sale, the first entry is to record the sale at retail price. Then the second entry is to record the cost of what you sold. And that expense account is called cost of merchandise sold. and then you will credit merchandise inventory. You credit merchandise inventory, the asset account, because your inventory has just left your store, so you need to make a journal entry for that. The cost of the inventory that you sold is $6,000, so that's the amount for that journal entry. Then transaction number 2, B company returned $2,500 worth of merchandise to A company. The cost of the merchandise returned was $1,500. So we need 2 entries to record the return. And remember, I'm the seller. So when a customer returns something, I call that sales returns and allowances for the retail price, which is $2,500. And I credit accounts receivable because now they owe me less. Because if you return a product, then you don't have to pay for that product. And then I'm going to reverse that second entry, which happened in number 1, by debiting merchandise inventory and crediting cost of merchandise sold. Because I didn't sell it, so I'm going to take it out of there. And the cost of what was returned is $1,500. The third transaction is when we actually receive the check from the buyer. So when we receive a check, we always debit cash for the amount of the check, $7,275. And then you have to ask yourself, why did they send me a check? Well, they sent you a check because they owe you money for the goods that they bought. So there is an accounts receivable set up for B company, but their accounts receivable account says that they owe you $7,500, so you're going to credit that account for the full amount that they owe you, which is going to wipe that account out. It's going to zero that out. And then you need a debit of $225. And if you are the seller and you keep up with sales, you also keep up with sales discounts. And that is a contra sales account with a debit balance, and you're going to debit that for the amount of the discount. And that is your journal entry to record the receipt of payment from the buyer. These are the journal entries that you need to know for your test for Chapter 6, Accounting for Merchandising Businesses.